Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for August 25th, 2018. Let's start with the fact that I'm a bear living in a bullish world. The SPX closes at effectively the all-time high, yet I continue to take and kind of pick off some great bearish positions in the midst of what has been the longest bull run in history. And I gotta tell you, in terms of those bearish positions, that's where I wanna be. So in a few minutes, we're gonna cruise over to some charts, and of course, as we get to the charts, we're going to look at things like expected move in the SPX, but let's not worry about any of that right now. Let's talk about a number of these bearish positions that I have actually taken in what has been an utterly bullish marketplace. So let's get started on this front, really into the context of why some bearish positions in the midst of this big run-up. I mean, let's keep this very, very kind of, simple. Let's not drill down into every single detail right now. Real high level. Okay? Do you, as a trader or an investor, do you really want to go out right now? Do you feel it like, hey, I really want to buy Amazon at $1,900 at an all-time high? You're like, ooh, I got to get me some of that Costco stock there because there ain't no sale on the stock, right? Maybe in the store, not necessarily on the stock. Do you find it extraordinarily difficult to go out and to want to purchase underlyings at effectively all-time highs, uncharted territory to the upside? Whether you're a trader or an investor, that is a tall task. That's something that, is ingrained in me to not want to do as a trader. Like, who wants to go out there and be like, yeah, so I'm the guy, that's me, I bought Microsoft at the all-time high, I had to do it. And I remember that all the way back from trading in 99 and 2000 when people go out there and they would buy eToys. That was a good one, all-time high. And of course they're no longer with us. That is eToys. Anyway, if we kind of continue on this front, it's not just about intimidation of buying the all-time high. It really comes down for me to just risk reward. And I want to keep this in the simplest context. Let's not even worry so much about the underlyings right now. It comes down to risk reward. And in every position that I'm looking at, whether it's a trade, whether it's an investment, I often look at, hey, okay, whatever the time frame is, let's say, I'm going to have a position on for a month. What do I really believe the upside potential happens to be versus the downside risks? Now, granted, there's a lot of different positions that you can take that are defined risk positions. And when you're in a defined risk position, and I'll just give you an example, go out, you risk a buck to be able to make a buck, then that upside potential versus downside risk doesn't necessarily play a big role. So right now, okay, if you're looking to take bullish positions, and you do want to step into stuff like Amazon, or you want to step into any of the tech underlyings that continually hit, okay, and take the markets to all-time highs, the way to effectively do that is going to be using defined risk strategies. So again, I wanted to spend a few minutes here in this video segment and really look at the logic, the strategy that you're employing, and not necessarily going out there and being like, I got to be that person that buys Microsoft again at the all-time high. Don't use the stock, use an options, make it a defined risk strategy, okay, and step into it. Now, when it comes to wanting to be purely long or short, this is where I say I'm a bear living in a bullish world. Then there are a number of strategies that we can employ. But when I'm looking to take a position in an individual underlying, and specifically a few bearish positions that I've currently put on, a few of them I've taken off, okay, there I'm actually using a synthetic, okay, short position. So for those of you that speak a little bit of geek, you can go out, you can get long stock, you can get short stock. Pretty much everybody gets that, right? So short stock can be, again, intimidating. Why? I don't know, look at Amazon. I think that's intimidating if you were a short seller. Look at Tesla. Okay, well, Tesla maybe worked out for some of the short sellers, but when it comes down to it, I don't even necessarily want to go out and short the stocks. You don't have to. You can just buy a deep in the money put over an 85 delta, and it's giving you 85 cents bang for your buck initially in terms of the short position. So again, buying a deep in the money put is my synthetic short. Now, I've rotated in and out of a couple of positions. And for those of you that if you've been following these videos, this year, let's just start the beginning of 2018. We can go back, look at some of the videos, some of the positions that we've taken. All right, what have we been short? Well, we've been short some Morgan Stanley. That's actually worked out extraordinarily well for us. We're out. We actually closed out of the Morgan Stanley position completely. We've been short Caterpillar, and by the way, I can go on and on and on of the positions that we've shorted, and you start to look at some of these underlyings, and you know what? They haven't performed well. That's good if you're short. They've actually been underperforming, of course, the marketplace. So again, we're able to pick off some really effective bearish positions. But before I get over here to the charts, there's actually a few bearish positions that I am going to update you on. First of all, I entered into a bearish position specifically on the XRT. Now, I mentioned this in last weekend's video. The XRT is the top performing sector. Top performing sector. And if you're not aware, the XRT, retail. Okay. 18 months ago, we're talking about a retail apocalypse. Now, in terms of like year to date, retail happens to be up 13% on a year to date basis. Right? It is giving me this great risk reward, which again, I'll show here momentarily. Another one we've stepped into this week, as I said, we've closed the Morgan Stanley short position. Now I've actually opened into JP Morgan. JP Morgan got a little bit of a bump earlier in the week, gave us a great entrance opportunity. Okay. Conversely, I've used a defined risk position inside of the FXC, which happens to be the euro. All of these, well, let's recap them right here, right now. And we're also going to look, of course, the expected move inside of this coming week of trade. Lots to talk about here on this weekend update. Let's go to the charts.
To the charts we go. And first and foremost, I want to continue a little bit on that example of something like Microsoft. And I think it's viable to question like, hey, do you want to be the buyer of Microsoft here at 108.40? One of the things you have to recognize is that, yes, there are individuals still out there buying the stock. That's one of the questions that come up all the time. People, they hit me up in the TheoTrade chat room or they email me and they're like, who is buying the stock at these levels? Well, you got to go past the most simple idea that there's not a lot of individuals that are just going out and buying the stock. So what is running the stock higher? Obviously, you could talk about stock buybacks till we're blue in the face, but let's not go there. Let's actually just discuss the fact that, do you allocate money to your 401k? Sure, lots of people do. Not everybody, but lots of people allocate capital to a 401k. When you allocate capital to a 401k, if you look specifically at those funds that are in your 401k, now remember, I spent 15 years in the brokerage business, so very familiar with how this works. If you look at the funds that are in the 401k, most of them actually delineate that you are going to have to keep 95% of that capital will be vested. What that effectively means is as you throw money into the 401k every other week, once a month, whenever they're actually extracting that capital to go into the 401k, the fund manager blindly throws capital into the markets. Okay, markets continue to kind of appreciate. So you could be unknowingly right now, you're the person buying it at 108.40. A little disturbing on that front. It's also a little bit disturbing as when you look back at the period just before earnings, you'll actually see the stock dip a little bit. In fact, you'll see that in a lot of tech stocks. You're like, oh, what does that have to do with anything? Because this is what we call a blackout period. This is when stock buybacks, they can't happen there. And you can't have the stock buyback till after some of the earnings announcement, and then you get the upward momentum again. Anyway, it's quite comical, but from a purely risk reward perspective, this is not a stock I want to buy, right? However, if I wanted to just throw on a bullish or bearish trade, the way that I would want to deploy my capital would be through the use of some type of defined risk strategy. And when I talk about defined risk strategy, it's something as easy as, hey, I want to get a little bit bullish right now. How can I get bullish? You could use what's called like an in-out spread. One strike in the money, one strike out of the money. Listen, it's a $2 wide spread for $1, right? Risk $1 to be able to make $1, but there's some nice attributes of this particular strategy that goes deeper than that. So I'm not opposed. I talk about, and I was joking a little earlier about being the bear in the bullish kind of world, but it's fine to take both bullish and bearish positions. So I wanted to kind of explain a little bit, again, in terms of risk reward. For those of you that want to invest in something, I find this incredibly difficult. I mean, you're stepping out on a ledge at this point in time to take that bullish position, and what's that upside versus the downside risks. And there's just no question that when going out and buying the stock, I always consider the downside risk. However, okay, rather than necessarily want to take a bullish position, okay, let's give you a few examples of, first of all, why I've actually taken some bearish positions in the very near term. So let's talk a little bit about JP Morgan. And I'm going to cruise over to JP Morgan for just a second, pull it up on a year-to-date percent. On the year-to-date percent, what I want to highlight on this front, it's up just over like 6% on a year-to-date percentage basis. But the point of this is first of all, I have decided that I want to take and will continue to take a number of bearish positions inside of the financials. Now, there's some fundamental factors, there's interest rates. I mean, I can go on all day about all the factors in terms of why do I want to get bearish inside of some of the financials. And again, best served for another day. Today, we're talking more about the strategy, more of the logic. So I stepped in and I shorted JP Morgan, but I shorted JP Morgan, okay, through the use, okay, of deep in the money puts all the way out here, which is again a synthetic replacement, okay, for short stock. Now, JP Morgan's up 6%. What I effectively did is I rotated from my Morgan Stanley short. For those of you that have followed the Morgan Stanley short was right in this neighborhood over here when it was up, 10, 11% year to date. Now it's actually down 7%. So I took off the Morgan Stanley position. Why? Because it was incredibly profitable. It was incredibly profitable, but when I start to look at Morgan Stanley in relation to some of the other peers in the sector, one of them, of course, being, you can look at Citi, you could look at JP Morgan, you look at Bank of America. Yeah, I don't even talk about Wells. I'm sorry, I can't do it. Can't do it. Anyway, when you start to look at some of the peers in the sector, you're going to find out that on a percentage basis, and this matters, on a percentage basis, JP Morgan is cooking. It's up like 6%. They like Jamie Dimon. If you look at Citi, it's down almost 5%. You look at again, Morgan Stanley down 6%. And of course, the mother of all products, Bank of America is up about 3%. So at this point in time, I wanted to come in and I wanted to short what was the strongest of the peers inside of the sector. Nothing I ever do is based on looking at one individual chart. I want you guys to recognize that there was nothing in this chart that was oh yeah, I got to short that. And if you're not comfortable inside of JP Morgan, you can come right in here into the XLF itself. Now, make no two ways about it. I also have a number of positions inside of the XLF where I am also holding on to short positions here as well. Again, the XLF, just to show you a little bit of a contrast here, and people are like, why are you short the XLF? Well, okay, first of all, we are hitting all-time highs inside of the S&Ps. Is the XLF at all-time highs? Nope, it is not at all-time highs. So having shorted the XLF, okay, has been, decent, but it's been very, very selective. The XLF positions are not paying me nearly as well as going out and having shorted some of the individual products, specifically Morgan Stanley on this front. So that's one of the positions, of course, that I've embarked upon. Specifically, the position I'm referencing happens to be the JP Morgan position. Okay, that's one of the ones that I've kind of, jumped into literally this week. I've now allocated capital on the short side of JP Morgan. We'll see how it kind of plays out. The other one this week that I think is well worth updating you on is the XRT. Now, this one, much higher stakes, right? The XRT, you should be a little bit more uneasy about this position. First of all, on a year-to-date basis, thing is up almost 13% year-to-date, okay? So I'm coming in here and I'm actually using, again, and I want to be crystal clear about both JP Morgan and XRT. These are what I would term, okay, duration positions. So let's quantify, okay, duration positions. Duration, what does it mean? I'm going to hold the position in excess, okay, of 3 months. In excess of 3 months. Now, I may have gone out and initiated a position, a synthetic short that's only 55 days out. And you go, well, Don, you put a position on that doesn't even have 2 months. Yes, I have every intention, okay, is I have bought a put in here, and I'm going to take that put, all right? So here's my put that's out in October, and I'm going to be rolling that out and rolling it out. And I'm going to be trying to roll those effectively for a credit. So I want you to understand the logic that this is not, again, a short-sighted decision. I've gone out there, I scored my 85 delta position, and I'll be looking to move that into November when I can actually do what? Roll it at appropriate time. When I say roll it at appropriate time, I'd be selling the option in, for example, October, turning around, buying another option out in November, and doing it for a decent credit. Now, effectively to do that, what would I need? I need a down move inside of the XRT. The XRT, though, so it's up 13% on a year-to-date basis. If you take a look at this over 1 year, it's stellar, 32%. Okay, so why the XRT? Like, why now? I don't know. I took a look at, underlyings like this, like Ross Stores, some fairly wild volatility hitting a couple of these. Take a look at Walmart. Again, these are not necessarily components of the XRT, but retail itself, let's actually cruise out to retail. Retail itself, there's a number of key retailers that have actually shown, possibly topping formations if you're into the technicals. But for me, it has everything to do with, how retailers performing versus other sectors. And right now, you're not going to convince me that retail should be the top performing sector. This was capital that rotated into a beaten down sector and nothing more. And eventually they'll realize like, what have I done? This is retail. I mean, people talking about like a growth story in retail. Not growth, it's absolute survival. Oh, please, I'm hanging on by a thread. And yes, there are some great turnaround stories, but does that mean that the retailers, should be up on a percentage basis more than, for instance, your tech sector? And that's where I have a little bit of a sticking point. Now, I wanted to go through and again, kind of hammer why I'm taking a couple of bearish positions and what has been, it's the ultimate bull market. And I'm not here to be, the consummate bear. I'm here to take and find viable positions. Regardless of what you may think about the marketplace, I'm here to take and to find viable positions and not get either you nor me into extenuating risk circumstances. And that's why, number one, if I am taking these bearish positions, I'm doing it with defined risk. The other aspect is, of course, you could do this inside of an IRA, right? Your IRA, because you're buying a deep in the money put. You can't short stock in the IRA. Now, the other aspect that we have to look at, of course, on this weekend's update here is specific to the SPX. The SPX, it was really kind of a lackluster week, on the whole. So we had last week right around a $34 expected move, and I like to kind of label these for you. So we were sitting here on, again, around a $34 expected move. Now, that's looking for $34 higher, $34 lower. You're going to laugh, you're going to cry, but we didn't get anywhere near the edge of it, which is, again, displaying a little lack of volatility. Now, this next week out, what are we looking for in terms of the next week effectively of trade? Well, the next week of trade, things get interesting. Interesting how? Well, things get interesting in the fact that coming into a holiday and there's not going to be a tremendous amount of news. We're looking at about a $31 expected move. So volatility has kind of contracted a little bit. Well, what's interesting about that? Well, what's interesting about that is it's going to afford us some great opportunities on an intraday basis. And you're like, well, how? How? Why? So the SPX offers Monday, Wednesday, and Friday expirations, as does the spiders. Let's go cruise over to the spiders for just a moment. And if you take a look at the volatility, here in the spiders, like for instance, the Monday expiration. Now, we're going to be coming into this holiday week, right? It's the end of summer, people. It's August coming into this holiday week. But look how low the volatility is for Monday. And you're like, well, what's the advantage of there? A 6.6 IV. That effectively means you can buy these options and just sit there for portions of a trading day. And you're like, well, which option should I buy? When they're coming into to expiration like this, anything right around a 50 delta, that's not exactly a lot of risk, is it? It's a 50-cent option, in a marketplace that just moved. And again, let's kind of quantify this. So there's an option that's at the money, whether it's calls or puts. It doesn't make a difference to me whether we want to be bullish or bearish, but you're afforded the ability in such low implied volatility times, you're afforded the ability to buy an option that is dirt cheap, look at the movement that we got in the spiders, for example, on Friday. All right. Even if you got half of that movement, these options are viable to buy. And this is where, again, a lot of people, they don't see it. Okay. Like, what don't you see? You can go out and buy an option for 50 cents. If this product, okay, is really rocking and moves, for instance, $1.50 in a day, this option, again, would explode in value. This put, right, with a dollar move, okay, there's a dollar move, it becomes a 50-cent option, comes almost $1.08, $1.50 kind of move, you're looking at what? Making, that option turns into $1.50, of which you paid 50 cents up front, so you'd be risking 50 cents to be able to make $1. Who wouldn't want to do that, even if you're right half the time? That's something we cover on a day-to-day basis right in the TheoTrade chat room. Join us throughout the course of this entire week. By the way, we are got lots of new instructors up to speed, and we're now filling the entire trading day with our traders, live trades in the chat room throughout the course of the day. Again, join us each and every day. Thanks, everybody, for joining us here on the Weekend Update. Have a wonderful weekend. Bye-bye.